Good afternoon, everyone. It's great to have you join us here this afternoon. Thanks for taking some time out of your schedule to spend some time looking at last year's financial numbers. We have Garry North with us again, ready to give us some good data from last year and also provide some timely commentary. So, yeah, thanks again. We really appreciate your support and your willingness to, like I said, take a few minutes to join us here today. So, Garry, take it away.
Awesome. Yeah, thanks, Lyle. Excited for you all to be here today. We're going to look at really what happened in the markets last year and maybe a little bit of where we could be headed. Of course, you know, at Masters, we don't make predictions, so this won't be a crystal ball type of webinar, but we are going to try to just take stock of where things are and where we sit today in the market. Feel free to throw your questions into either the chat or the Q&A. Lyle will be monitoring that throughout our time together, and we'll pause at a few different spots during the webinar to take those questions and talk through anything that comes up. So with that, let's jump in. We're going to start with equities, also known as stocks, and real high level look at what this last year and longer than that has given us in the stock market. And it's been another roaring year for stocks, especially US stocks. So you can see in the upper left-hand corner, just finished up 2021, and the US stock market as a whole was up about 25.5%, doubled up what international stocks did in developed markets. And then emerging markets had a rough year, down 2.5% this year. The U.S. bond market as a whole was down 1.5%. We're going to talk more about the bond market. We've been getting a lot of questions about that, which is understandable given the current environment. And really the main reason for negative returns in the bond market was a rapid rise in shorter term interest rates, which are still low by historical standards, but nonetheless did increase pretty significantly in the second half of last year. And so we want to take stock of where the bond market is as well. At Masters, we're long-term investors, and you as our clients are as well. So yeah, we want to know what happens year over year. We want to think about that and consider how we're positioned for the year that we just had and the year ahead. But of course, we're more concerned about what's going on here in 5 and 10-year periods of time. And of course, as we sit here today, we've had a very, very strong environment for stocks, both in the US and international, not to the same degree as US, but we have had that for the last 5 years and even the last 10 years. So it's been a good run of markets, and 2021 was no exception. This is a look at about the last 25 years of the S&P 500. The S&P 500 is the 500 largest stocks in the United States, so it's just a slice of the market, but it gives us a good indicator for where we are today and what historically has happened in the United States from an investing standpoint. And what you see and probably already know is the market goes through periods where it increases and it grows, and it goes through periods where it contracts. And that really follows the economic cycle of the United States. We have a cyclical economy, and we go through times that are really strong, and the stock market tends to follow that. And we go through times where we contract and unemployment goes up and wages go down, and we have to work through that to then recover. And the stock market is very similar. But as you can see, since the blip we had in March of 2020, the market down 34%, and that happened in about a month. It was a very quick down, but then a very quick back. We are now up 113% from that low in March of 2020 as of the year end 2021. So it was a very quick recovery. In general terms, we like to say that when there's a major correction in the market, when the market decreases by 20% or more, the amount of time that it takes the market to go from top to bottom it takes us about double the amount of time to get back up to where we started. So if it takes the market 3 months to go down 30%, it'd be reasonable to assume that it might take about 6 months to get that back and then start to climb beyond where we started. And that was no different back in 2020. The market was down 34% in about a month and a half, top to bottom. And it did recover in about 3 months. Took a little longer than that, but it followed a similar pattern. And since then, it's been pretty much straight up. We have seen some heightened volatility at the end of last year, but for the most part, it's been a very, very good run in the United States up until this point. One thing that we have to experience when we're stock market investors is that risk and reward are generally linked. So the more risk we take over time, the more reward that can give us, but also means we have to deal with some downsides. One of the unique things, however, about last year, 2021, which is this last bar on this chart, is that we had a great year, up 27%, and we had very little downside. So the biggest decline of the market last year, top to bottom, was only 5%. And as you can see, going back to 1980, that's a pretty low number, especially for some of these good years that we've had. And of course, especially compared to 2020 when we experienced that 34% decline top to bottom. So again, it has been a pretty smooth ride for last year, and we will see whether it keeps going here in 2022. But part of being a stock market investor is if we want the ups, if we want the good years of up 27 and 29 and 30 and 23, we have to be able to withstand these downturns when the market's down 10% or 28% or 12%. And it's pretty normal for just about every year for the US stock market to decline 10% at some point in the year. We didn't have one of those last year, so it wouldn't be unreasonable to assume that we get a quick 10% down at some point in the future, just based on historical standards. At Masters, we think about the market more than just the S&P 500 because it's much, much bigger and broader than that. And there's a lot of numbers on this chart, but really what we're seeing here is what the different parts of the market returned specifically in 2021. We can slice up the market into a few different categories. And here on the left side of this chart, you see the size of company as categories. So we have smaller companies, we have mid-sized companies, and we have larger companies. And of course, those larger companies would be the ones you know, Apple, Amazon, Google, all those big companies that we know and probably use every single day are in this category, in the large category. And then we do have some mid-sized companies and some smaller sized companies. And then across the top, we break the market into 3 other categories, which is value, blend, and growth. What that means is a value company would be cheaper from a price standpoint relative to the amount of earnings that they produce. So a value company would cost less for you to acquire based on their earnings than, say, a growth company would be. The most important metric in general for a value company would be cash flow, where the most important metric for a growth company would be revenue growth. So the value companies tend to be more cash flow driven, the growth companies tend to be more top end growth driven, and that's, of course, the blend companies are somewhere in the middle of that. But that's a pretty traditional way to slice up the market. And what you see is it was pretty consistent in this part of our box that we had really good returns all across the larger company space, in the mid value and blend space, and especially in the small value space, which actually was the best returning sector in 2021. But here are the areas that struggled: the mid and small growth space and the small blend space to a lesser degree. And so it was interesting to see this year because generally when the market has positive returns, without too many bumps in the road, these categories tend to move together for the most part. They tend to act very similarly to each other. So starting to see some differences within the broader market of returns could be telling us that, oh, maybe there's some things going on here that are leading to different returns, and we may want to be a little more aware of. And that's 2021 in a nutshell. Again, if we go over here to 10-year returns, what you can see is large growth has been the winner over the last 10 years. That historically is not necessarily the case. Typically, we see the value side of this box be the ones who outperform over longer periods of time. But these last 10 years have been a very good run for these larger, more growth-oriented companies. And they're generally aided by positive markets and positive markets without too many disruptions. They tend to maybe struggle a little bit more when the waters get choppier. And then one last really interesting piece of this chart before we jump over to valuations is this box down here, which is showing you since the market bottomed out in March of 2020, we had that down 34%. What have each of these sectors returned from that point? And you can see in general, pretty similar returns across the board, but if we're picking a winner, it's down here in small value. So small companies that are priced more attractively in the market have performed the best over that period of time. On the right side of this slide, what we're seeing is price to earnings ratio. And price to earnings ratio is kind of a fancy term, but essentially what it means is you take the price of the stock, you take the earnings that that stock's producing, and you divide them, and that gives you a multiplier. How many times earnings is the stock worth? And this is a really important metric, we believe, at Masters, because it tells us, is the stock more expensive? Is it adequately priced, or is it maybe a little underpriced as we compare it to the rest of the market? What we're seeing here is the current price earnings ratio of all these different categories versus the 20-year average. As you can see, usually growth companies have higher earnings multiples than value companies. So large growth companies average 18.5 times earnings, while large value companies only average 13.7. So we typically see a spread there, but I'm going to come back to this a little later to give you a preview of it. Look at where growth is right now, trading at 30 times earnings while value's trading at only 15.8. So growth companies are going for almost double what value companies are going for. And part of that is because the positive run that they've had recently, but it's a very interesting fundamental number that we're keeping an eye on here at Masters, and we'll talk about towards the end of this webinar. Lyle, that's probably a good place to take a brief pause since we are motoring through the data pretty quickly and see if we have any questions on that piece.
Yeah, just a reminder, if you have a question, you can either type it in the chat section or the question section. I'm monitoring there. Garry, as we're going through this, it just kind of strikes me, a number of indicators seem like the market is, it's been going up for quite a while. I think the mountain chart that you showed, you see that spike at the end there. It certainly feels like we could get some kind of correction or maybe even a more significant pullback in the market at some point here. Who knows when, but probably sooner than later. I'm just curious what your thoughts are. If someone's sitting on, a significant amount of cash right now that they're interested in positioning maybe for 8 to 12 years, so a fairly, longer time frame. What would you be doing right now? What would you be thinking about?
Yeah, it's a great question, Lyle, because in investing, we have to walk this fine line of not being too predictive, but being very aware of where we sit today and what that could mean for the future. But we certainly want to stay out of the business of predicting the market. It's bigger than any of us can even fathom, just the volume of trading that happens any day in the market, and there's so many factors that go into what happens. We don't want to be in the business of trying to predict. But I would say we would look right now and say there are parts of the market that are a little more expensive relative to historical standards. And so it would be prudent to maybe be a little more cautious if you have cash sitting or if you have money you know you're going to need soon. Typically, our approach at Masters is we don't want to do anything that's too extreme. So we wouldn't look at this and say, oh, send all your money to cash. And we wouldn't look at the market when it's relatively cheap and say, oh, put 100% of everything in stocks. So the answer I'd give to that question is we want to be well aware of what our risk tolerance is. You know, if I'm the client, what is my risk tolerance? And that's going to be give me some guardrails. And maybe in a time like this in the market, I want to lean toward the more conservative end of my risk tolerance. So if I should have an 80-20 portfolio or whatever's determined by your advisor, your financial plan, but I'm comfortable going up to 90% stocks or down to 70, maybe I want to be on the lower side of that. So I think we look at the risk that we're comfortable taking, and maybe we be a little more conservative with that risk. Maybe we hold slightly more cash so that if the market does correct, we can jump in at a more opportunistic time. But we don't want to get too far out of those bounds into a place where we're making really, really big bets. We're going to be much better off making a lot of smaller bets over time than one big bet here, another big bet there if we want to increase our probability of success.
Good.
Any other questions, Lyle, in this section?
I think we're good here. Yeah, we can move along.
Okay.
Thanks.
So a little on international, of course. We all live in the United States, so we're always a little more interested in what's going on here, but there is a lot of investing opportunities out in the rest of the world as well. This is international developed stocks. This would be developed companies, the developed countries, excuse me, that you would know of, the United Kingdom and Germany and so on and so forth. And this actually makes up about 29% of the total value of the world's stock holdings. So it's a significant portion of the overall market. The United States makes up about 60% of the total investing universe. And as you can see, this is returns from the fourth quarter here in the ranked returns. But if you pay attention to this 1 year column, what you'll see is developed markets, as we saw on the first page, have underperformed the United States over just the past over the past year and over the past couple of years. And so you might be wondering, well, you know, if the international markets aren't doing as well, should we still have them in the portfolio? And a little bit later, we're going to look at just the patterns that we see and why we believe some diversification in the international space continues to be prudent. But certainly the international space has lagged behind the US as of late. Then we have the emerging market, which would be not the developed countries that you know, but the more up and coming countries. And emerging markets really did struggle last year. Overall, we're negative for the year, but one interesting outlier is small cap emerging market stocks up almost 19%. So we kind of had this interesting phenomena in emerging markets where larger growth-oriented stocks really struggled, down over 8%, but smaller, more attractively priced companies were up almost 19%, somewhere there on par with how the US market did. So a little more dislocation of returns in the international space. Emerging markets makes up about 11% of the total investing universe. So in our portfolios here at Masters, we do have some emerging markets exposure, but not a significant amount. But it's still an important piece of the portfolio from a diversification perspective. But again, just like developed markets have lagged behind the United States as of late. This is a very interesting slide just to give you an idea of the United States versus the rest of the world. So that's what we're looking at here, is back to 1971. There's periods of time in purple where the rest of the world outperformed the United States. There's periods of time in gray where the United States outperformed the rest of the world. And what you'll see, of course, is a pattern. The rest of the world outperforms, then the United States, then the rest of the world, then the United States, and so on and so forth. Some of those times are shorter rather than longer, but as you can see, we've been in a 14-year period where the United States has outperformed the rest of the world, and not by an insignificant margin, about 275%. The last time we had outperformance from the rest of the world was back in the dot-com era, where a lot of the dot-com companies that really weren't worth anything were based in the United States. The rest of the world was a great diversifier in a portfolio during that time period from 2000 to about 2008. So it's an interesting pattern because it's a reminder that, yes, 14 years is a long period of time, but again, these things tend to be cyclical. And there are periods of time where the United States has significant underperformance, and developed and or emerging markets provide a nice diversification benefit in the portfolio. And a little later in the webinar, we'll look at a little more data on why we want to continue to consider having that as part of our asset allocation, despite this recent underperformance that is rather significant. So Lyle, that's what I had on international stocks. Any questions there?
I didn't have any questions pop up, but just one comment here on the slide that really stood out to me is the decade of the 80s and the international outperformance there. In the investing circles, there's some conversation around, is international investing dead? And I think you make a good point that it's clearly cyclical, but yeah, there's always the possibility that we hit another decade of the 80s where international is really, really strong relative to U.S. investing. So I think it always makes sense. I know we believe here at Masters that it always makes sense to have some diversification to the international sector.
Yeah, again, like you said, it is cyclical. And the other thing to note is, we do still have what would be called a home bias in our portfolios. We have more of an allocation to the United States versus what it makes up in that 60% of the overall investing universe. So we still do favor weighting towards the United States markets. But like Lyle said, we're firm believers. And again, we'll see some things later that I think will show you why there is some merit to continuing to have international stocks in the portfolio. Great, so next we're going to talk a little bit about fixed income or bonds. Not always the most exciting part. This isn't really where we get the juiced up returns, but a very, very important piece to a portfolio. And this is a current interest rate curve in the United States today. This is looking at Treasury bonds, so US government bonds. And what you'll see is in a very short period of time, this bottom line is August 4th of 2020, and that's that bottom purple line. The middle line is year-end 2021. So less than a year and a half, you can see how this curve has changed. The 20-year bonds up 1% in yield, the 10% bonds up 1%, 7 years up over 1%, 5 years up over 1%, and so on and so forth down to the shortest term fixed income instruments. And so that's something that we've been really mindful of here at Masters. I know it's something that a lot of you have probably heard about or thought about, is if interest rates continue to increase, how should we be positioned in fixed income so that we're ready for that? And we'll look a little bit later, a few slides down the road, as to how we think about investing in fixed income today. Some of you remember that back in the late 70s and early 80s, you were seeing not 1.94%, but maybe 19.4% on a 20-year bond or CD or something like that. And really, since that period of time when interest rates peaked and there were 16, 18% CDs and 20% mortgage rates and I just was with a client who had a business back then, and they had some debt in their business, and they were paying what's called the prime rate plus 5%. The prime rate was 20%, so they were paying 25% on their debt. We're now at the very opposite end of that spectrum. We've been in this low interest rate environment for really 8 years. We've been in an environment like we're in now, but we're starting to see some signs that maybe we're not getting to 20% anytime soon, but maybe these interest rates are going to continue to climb, and we have to be mindful of that from an asset allocation standpoint. A little bit more on fixed income that is interesting and might tell us a little bit about what's going on in the market is debt overall. And so this first chart is looking at different types of debt relative to GDP. It probably doesn't surprise a lot of you to see this gray line, which is government debt, go way, 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 way up from back in 2020, obviously with all the stimulus and all the money that was passed through, that's really increased government debt as a percentage of GDP. But a positive element is since 2008, which really was a debt crisis back in 2008, we've seen a steady decline in household debt. So we peaked at almost 100% of GDP, so basically 1-to-1 debt to GDP, which means essentially if all the assets in the country were liquidated, we'd be worth $0. Not a great equation. But since that time, we've seen a steady decrease in household debt. And we did get a little bit of an uptick last year, but are still sitting about 79%. And as you can see, historically speaking, yes, we're a lot higher than we were in the 70s and 80s, but we've had this nice downward trend since 2007 and 2008. And then specifically related to bonds, these are two interesting data points. Number one is looking at the amount of corporate debt outstanding for companies that are not in as good a financial position. So debt is rated on a scale of how healthy the underlying issuer, the underlying company, is from a financial perspective. And this is looking at companies who are in decent shape, but not the best ones. And what we've seen is since 2008, a steady uptick and increase in the amount of debt that those companies are issuing. What that tells me is more companies are turning to debt in this low interest rate environment to fuel their growth. And in really good times and in a good economy, that can be a great business move. Debt can get you more access, can get you more leverage and increase your growth rate. But of course, it is a bit of a warning sign that some of these companies could be out over their skis if things slow down or if we have a sudden correction in the market. And another factor that would lead us to maybe think that that could be the case is the duration or the length of time on the debt instruments or the bonds that are being issued has seen a significant increase just in the last couple of years. Again, what that means to me is companies are taking debt that it's going to take them a longer time to pay off. And that means if we have some choppy markets or we get some disruptions in the economy, that could put those companies in jeopardy of being able to meet their obligations. So there's certainly some slight warning signs out there. And at Masters, what we believe is these sorts of things just mean we have to be very cognizant of what type of bonds, what type of fixed income we hold in the portfolio, and make sure it's going to hold water if things do get a little bumpy. Again, a lot of data on this slide, but I'm going to point out just a few things. The first one is this right column, which shows the impact of a 1% rise in interest rates depending on what type of bonds you hold. This section right here is all United States Treasury bonds, so government bonds. And what you see is the shorter term the bond, the less of an impact a rise in interest rates has. The longer term the bond, down here's the 30-year US Treasury, the more of an impact a 1% rise in rates would have. What we're seeing here is on a 30-year United States Treasury bond, which you'd have to be comfortable buying one of these if you want to give the United States government your money for 30 years and get it back at the end. So that's one thing we have to consider. But if we get a 1% rise in interest rates, those bonds would see a negative return of between 18 and 20%. Very, very significant. Not what we want for our fixed income. We want our fixed income to be the solid rock of the portfolio that holds water when things aren't good. And so what this would tend to tell us is, we want to continue to hold shorter term bonds that are not as affected by interest rate rises. And when the interest rates do rise, because those bonds are shorter term, we can much more quickly get out of those bonds and put that money in higher interest rate bonds with rates going up. And then the last piece of this chart I want to point out is this column right here. And what this column is showing is really the foundational belief we have at Masters of the role that bonds should play in a portfolio. We believe that we have stocks in the portfolio to generate return, long-term return, and we have bonds in the portfolio to be a ballast. We want bonds to be steady. We want to be able to count on them, and we especially need to be able to count on them if the stock market has corrections and has downward trends. And so what we want to see is we want to make sure that our bonds are going to hold water and possibly even increase if stocks are down. This final column, the correlation to the S&P 500, shows us how linked the movement of bond returns are to the movement of stock markets. The higher the positive number is, the more linked they are, which means we don't want bonds that act like stocks. We want bonds that act unlike stocks, so that when stocks are down, bonds are up. And what you'll see here is the best option for bonds, for looking for them to provide ballast to the portfolio when stocks are down, are US Treasury bonds. They have negative correlation to the stock market. What negative correlation means in general terms is when stocks are up, bonds are flat or down, and when stocks are down, bonds are flat or up. Typically, when stocks are up, bonds just kind of chug along. You collect the interest rate there, but you get your return out of stocks. But when stocks are down, you continue to get that benefit from your fixed income. So there may be people saying, I don't really like investing in a 5-year government bond because it's only going to pay me 1.26%. But if you want more yield from your bonds, if you want more interest, you're going to go down somewhere in here. These are all just different types of bonds in the market. You can see some of them pay you for over 4%, over 3%. But if we look over here, the higher yielding the bond, the more linked it is to the stock market, the more like stocks it is. And those are not the type of bonds we want to hold in our portfolio. Instead of holding those, we're just going to hold stocks. And then the last piece on fixed income, again, colorful chart, tons of data, but the bottom line here is each column is a year of returns. Each colored box is a different type of bond. And what you see is, in general, there's no discernible pattern of what type of bond does best each year. Some years, some are at the bottom, other years they're at the top, and some other years they're in the middle. But what is steady is a portfolio that combines a lot of these different bonds, and that's what this middle line is. This is an asset allocated portfolio that has good diversification, and we can see that gives us, from 2007 to 2021, one of the best returning solutions with some of the lowest amount of up and down. And that's what diversification does for us, is it smooths out the investor experience and ultimately leads us to positive returns long term. So Lyle, that's a lot on bonds and fixed income. So I'll pause there and see what questions there are on interest rates or bonds or anything we just discussed.
Yeah. The question here is kind of bringing in a different element, but there's a lot of talk about potential inflation, or more than potential. There's some significant signs of inflation in the economy right now. Inflation makes sledding for bonds difficult. You got it's generally rising interest rates to get ahead of inflation or to keep up with inflation, and then you also have just the factor that each payment coming back from the bond is having less and less purchasing power as we get in a more significant inflationary environment. So the question is, what do we do about that? I mean, if it seems like it could be a difficult time for bonds, I know you're saying that they need to be there for this ballast, but what do you do about inflation and sort of eroding your purchasing power over time?
Sure. Well, in general terms, that's a great question. In general terms, interest rates and inflation have a pretty high correlation, generally speaking. So that means in most cases, when inflation does start to increase, we would also expect to see interest rates increase. Now, there's a lot of factors in the market, and of course, we've got the Federal Reserve more involved in the bond market than they ever have been. And so that's a factor that's can be a bit of an unknown, but I would say we generally expect interest rates to follow elevated inflation. And so we want to stay disciplined to our philosophies in fixed income, just with that general assumption. The tough thing with inflation is really the only way to keep up with it in bonds would be to invest in what are called Treasury inflation protected securities, TIPS. And it's kind of what it sounds. It gives you a government bond plus inflation. The problem is there's a lot of complexity to these financial products, and really the only way they work out is if you get into them before inflation happens. So you have to be predictive, and of course none of us have perfect predictive power. And actually I can go back and show you, here's Treasury inflation protected securities. This just gives you a little idea of how complex these instruments are. Look at the interest rate on these right now. It's negative. It has a negative interest rate. So there's just some odd factors in that sort of investment. And we tend to lean toward, let's prioritize liquidity and let's prioritize staying shorter term with our bonds, so that when inflation rears its head, we would expect interest rates to rise after that, and we can quickly get out of those short-term securities and get into something that pays us a little bit more.
Good, thanks.
Great. So a little bit here on the economy. There's some interesting data here. This is showing on the right side the total components of our GDP. And GDP is just the total output of the United States economy. That'd be the best way to think about it. And so if you ever follow the financial news or you read headlines, you hear a lot of headlines about where consumers are spending money. And the reason for that is that our consumption makes up about 70% of the total output of our economy. So when something like 2020 happens and we stop spending money going out to eat, we stop spending money traveling, that has a major impact on our overall economy, which is why there's such a focus on it. You can see some of the other factors here: government spending, investments outside of housing, and then housing right up here makes up about 5%. But consumption's the big one. And so when we think about consumption, here's the trend in some of the big picture areas of consumer consumption since February of 2020. So we're looking at where were these consumer spending categories right before the big correction in March of 2020, and where are they now? And what we see is we've made it some of the way back, but just here in the last month, we've seen a tick down again in some of these activities. This gray line is debit and credit card transactions. We're well above by about 20% where we were back in February on that. So we're all still spending money. I guess we're just doing a lot of it online instead of going out and spending money there, because all these other factors are still down from their February 2020 numbers. The green is hotel occupancy, which is down 9%. It was down 69% in April of 2020 and is almost recovered. It did peak back up in December, but not quite back there. US seated diners was down 100%. That's hard to believe, but if we remember why that was back in April of 2020. No one was sitting down to eat. And we're still only back to down 24% on eating out. That's seen a significant tick down. You can see back here in August, we actually got back to where we were in February, but more recently, that has ticked down. So that's something that we still need to see some increase in over time to feel like the economy's in a healthy position. And then the last place is airline travel. That was down 96% in April and still down about 17%. So not back to February levels yet. But we've made a lot of progress since this part of the economy. And of course, the stock market follows that. So the better the consumer does, the better we can expect the stock market to do. What about consumer finances? In general, the United States consumer is in better shape today than we ever have been in history. This bottom right column is total household net worth. And as you can see, that's higher than it's ever been. These are huge numbers, so it's $150 trillion, but all you need to know is as a collective whole in the United States, all of us together, we have more worth than we've ever had. And another very positive trend is our debt ratio. Again, we combine all of our assets, all of our debt. It's as low as it has been since 1980. We're only looking at an overall debt, household debt ratio of 9%. So the consumer is still in very good shape, and there's some good things happening here for the consumer on the economy. The consumer balance sheet is interesting to look at just because it's things that we probably don't know. Total assets in the economy amongst all of us combined together is $162 trillion. You don't need to know that number, it's just a really big one. Of that, 25% of our assets are in our homes. So you might be thinking, oh man, home prices are up like crazy. They certainly are here in Lancaster County, and they are around the rest of the country as well. Should we be concerned about that? Well, the good thing is down here, mortgages, they do make up 65% of the total liabilities, but mortgages are currently making up about 15 trillion, just think $15 trillion of overall liabilities. And homes make up about 40 trillion, excuse me, of overall assets. So that ratio is still very strong. We're certainly not looking at a 2007, 2008 scenario where many people were out over their skis in household debt, and that's a positive thing. On the economy, unemployment and wages, unemployment rate is all the way back to 4.2%. Most economists would consider that full employment. There are more jobs available right now than people who don't have jobs. So the labor market is very tight. We have seen some wage growth here, 5.9% back in November, which is good. We are seeing, the consumer, the worker catching up with inflation, getting some wage increases. And again, this is another good sign of the economy, but you do see what this cycle looks like. Again, we're in a cyclical economy. And so we have periods of high unemployment, which are usually around the time we get stock market corrections. And we have periods of low employment, which tend to precede stock market corrections. So you could look at this and say, there might be some warning signs here. We don't want to be too predictive, But if history tends to rhyme, it never repeats, but it tends to rhyme. We may be looking at some difficulties here because we might not have enough workers to do all the work that needs to be done to keep the economy growing. And then inflation was mentioned, did have one note here on inflation. Just the most recent inflation number that came in November, 6.9%. As you can see, that's the highest number we've had since all the way back here in 1990. And of course, those big interest rates we talked about, they happened when there was a lot of inflation as well back in the late 70s. The biggest contributor to the inflation increase has been energy. You can see just November year over year up 33%, and even food up 6%, which is a pretty big number for something like food. So it's certainly something for us to continue to watch. Again, higher inflation. We are getting the wage growth, as we saw in the last slide, to help keep up with inflation, but it's something that we want to keep an eye on as investors. So Lyle, that's what I had on the economy. What questions do we have there?
Yeah, question here. Minus the the shutdown back in 2020, the economy's been on pretty much of a steady climb since 2009, which is like 13 years.
Mm-hmm.
What do you see as kind of the biggest threat to kind of derail this thing?
Yeah, it's a great question. The one statement we make is bull markets, which is positive markets, don't die of old age. So just because we've had a long bull market doesn't necessarily mean it's going to end. But there's typically two ways we see a really negative market period come about. One of them is some of these factors combining together that lead to slowdown that we just talked about. If we don't have enough workers to produce more growth in the economy can slow down. If we have too much persistent inflation, our purchasing power goes down, the consumer can't spend as many dollars, and that slows down growth. If we have companies defaulting on their debt, not being able to pay their obligations, that can slow down growth. So it can be a combination of those fundamental factors, but the most common cause of a major market downturn is a surprise. It's something none of us see coming. It's usually a major event like we had last year, like the banking crisis in 2008, like 9/11 back in 2001. It typically is something that nobody expects. It comes out of the blue, it has a major impact, and it shocks the market. So certainly there's some fundamental things that could lead probably more to economic slowdown versus a recession. But what we usually see precede recessions or trigger one is something completely out of the blue. So that could be something geopolitical, that could be something in the corporate world, but it's usually something that none of us see coming.
Good, thanks.
Great, so our theme here that we're looking at in Masters here at the beginning of the year is valuations. We've talked a little bit about valuations. We're gonna dive just a little bit deeper on them here. And when we look at valuations, again, we're looking at how much are we paying for the stock per dollar of earnings they're providing. We want the companies we invest in to earn money, to pay us cash flow that sends the stock price up and gives us our return. And so we need to be really cognizant of what valuations look like and how much we're paying per unit of earnings. There's a few moving parts and pieces here, but all you're seeing on this chart right here is value companies. So if you remember that box we looked at, we have value companies, we have growth companies. The price of value companies versus the price of growth companies. Right now, value is cheap relative to growth. So value companies are cheaper than growth companies. And it's almost at a historical low or high, however we want to look at that. The last time we had this sort of displacement of how expensive growth companies are and how cheap value companies are was all the way back here in 2000. And that was all the dot-com bubble, where anything with a dot-com got money, whether it was a real company or not, whether they had revenue or whether they didn't. And of course, that all collapsed in on itself. We're getting close to that level, which is very interesting, something we're keeping an eye on, and why we continue to tilt our portfolios toward the value side of the market. Another way to look at this same phenomenon is in this graph, which shows you the range of cheaper companies, which is the bottom gray line in the market, versus more expensive companies. So how much cheaper, how much more expensive are these companies from each other? And what you see is just since 2020, we've had this huge increase in how expensive the most expensive companies are. So the most expensive companies in the market have become more expensive than they were just a few years ago relative to the earnings that they provide and they produce. And what you can see is we're pretty much at an all-time high here. And the last time we had this level of dislocation was back here in the 90s and the 2000s. And back then we had 3 years, 2000, 2001, and 2002, of negative returns in the S&P 500. Over that same period of time, value companies, these companies down here, produced a total return of positive 6%. So we had 3 straight years of bad negative returns, yet value companies still made some money. So this is something we're continuing to keep a close eye on, is where we're positioned and making sure that we're not out over our skis paying a premium for companies that could maybe come back down to earth at some point in time from a price standpoint. I mentioned international earlier. Valuations are also a major factor in international investing. And as you can see, again, we're looking at charts, so we're just looking for patterns. You don't necessarily need to know what numbers are going on here. What this is showing is, again, price to earnings ratio. So how much we're paying for these companies' earnings of international stocks versus stocks in the United States. And what you're seeing right here is we have a by far all-time low of that difference between the US companies and the international companies. What that means is you're paying much, much, much less for each dollar of earnings for international companies than you are for companies in the United States. And so we continue to look at this data and believe that this is a good indicator for us to say we should continue to be diversified in international markets, because things are still on sale in the international markets, where in the United States some things are getting a little bit more expensive. So Lyle, that's a little bit on valuations. What questions do we have on that?
Yeah, no questions here. I think that the data here is pretty convincing that a diversified portfolio makes sense, back to some of the things we had talked about earlier in the presentation. Just again, a good emphasis that international is not dead, and it makes sense to continue to hold it.
Yeah, absolutely. Yep, absolutely. So the last thing I have here, I call them anecdotes, just 2 slides of just interesting observations that I made through some of the research for preparing here for 2022 and investing in 2022. This first one shows us something called margin debt. What margin debt is if you're an investor and you have money in an investment account, you can open what's called a margin account and borrow money against your investments to increase your total investing exposure. And so you say, well, why would you do that? You would do that because if you have positive returns, it would increase your returns, because you can get more money invested by leveraging the money you're getting from the debt. Of course, the downside is if your investments don't do well, you still need to satisfy that debt obligation. And so it can really go sideways on you quickly. What we're seeing here is margin debt, the amount of it in the marketplace, tends to follow very closely returns of the S&P 500. And we know investor behavior. We see it behind me when things are going really well. We want to continue to pump money into the market. When they're not going well, we don't want our money in the market because of bad returns. And we're seeing the same phenomenon here. The better the market does, the more margin debt is taken on by investors. And the reason I show you this is just interesting to see that right now, of course, we're at all-time market highs. We're also at all-time highs for investor margin debt. And if we get any sort of significant correction in the market, that is going to go very, very, very bad very quickly for the folks who are going to be out over their skis. So that is one thing that just shows us how we're not always the best as a collective group of investors at doing the right things. You know, the better the market does, the less debt we should have. But we're seeing that the typical investor here continuing to increase the debt to borrow more and more money to try to continue to chase returns. Here at Masters, we don't believe you invest to borrow. We don't have any margin in any of our accounts, nor will we. But the average investor is currently doing that to chase higher returns. And then the last anecdote for today is another really interesting phenomenon that it's interesting to see how it will play out. And this is the percentage of IPOs. So an IPO is an initial public offering. So that's a company who becomes public. They're private. They list their company on the public stock market, and now they're a public company and their stock's out there for anyone to invest. This is showing what percentage of companies who go public are profitable when they go public. What you can see is back in the 80s and the 90s, for the most part, about 3/4 of companies who went public were profitable. Of course, that bottomed out. You're seeing a theme. There's a lot of stuff that happened in 2000. A lot of these .com companies going public with really no revenue, no profits, and we were down to about 25%. And that's where we are today at the end of 2021. Only 25% of companies that listed on the public exchanges in 2021 made money. And so it's an interesting thing to watch because, again, those companies who don't make money, if they see a decrease in their revenues, if we see disruption in the economy, how are they going to survive? How are they going to recover from that? We want to continue to be very cognizant of what type of companies we're holding in our portfolios. So Lyle, that wraps up what we had for today. What concluding thoughts or questions do we have in our last 2 minutes?
Well, just kind of a number of things came through the slides in the presentation. Just some things that I think would give me pause or caution about the markets going forward. Again, we never know. These things can continue to run on for a long time, but it certainly makes sense. I think the theme that I came away with was that maybe to be a little bit more cautious. Some of the things that you mentioned earlier, I think were really, really good suggestions. Maybe you hold a little bit more cash. Maybe you are on the lower side of your risk tolerance. Those types of things seem like a good conclusion to the numbers. So yeah, that was just a couple of my concluding thoughts.
Yeah, and what I would add to that, Lyle, is make sure we're aware of where we're invested. Make sure we're aware of what we hold. We don't want to just close our eyes and throw money into stocks and bonds because we're going to get surprised. So lean toward maybe a little bit of caution. But again, we've seen periods of time where metrics like we're looking at today seem to indicate that maybe the market was due for a correction, and it has persisted for significant periods of time. We've seen numbers like this persist for years and years at a time, even when it doesn't seem rational. So that's why we always want to take this very balanced approach to investing. We never want to go too far one way or too far the other. We just want to tilt here and tilt there. And if we are consistent and intentional in where, when, and how we tilt, over time, those little things add up to a really positive investing experience.
Yeah, and maybe a better way to frame what I was saying is maybe the caution needs to come about just throwing money into something like the S&P 500, which is going to be really focused in some of those larger more growth type companies. And because we also pointed out there are some opportunities out there. International looks attractive. Even some of the value stocks here in the U.S. seem like they're at least not overly priced. So maybe it's just about being caution in the right areas.
Yeah, I think you're right on, Lyle, and that's exactly what we're doing at Masters with our investment review committee. And for all of you as clients, of course, if you ever have any questions or you want to dive deeper on any of this, or make sure you understand what's in your portfolio, of course, don't hesitate to give us a call, send us an email. And thank you to everyone for joining us today. We hope you have a great rest of the evening. Thank you.
Thanks.